Hi, everyone. I'm Rosemary Miller here with Rob Isbitts, the founder of sungardeninvestment.com and ETFyourself.com, here to give us an overview of Q1 stock market trends and offer a little advice for new investors. Thank you so much for joining me today, Rob.
Hey, great to be with you again, Rosemary.
Rob, so could you provide a recap of Q1 trends in the stock market, please?
Sure. I think that to look at this, and by the way, I mean, we're recording this a day after April Fool's, so, hopefully people didn't get fooled too much in the first quarter, but the second quarter already seems to be starting a little bit different. The vibe is a little bit different. And I feel after almost 40 years of being a professional investor that I can use words like vibe to describe the markets. But now I'll go into some of the detail and the whys and wherefores behind that phrase. So in the first quarter, technology stocks didn't lead, and that was the first time really that has happened in a while. Energy stocks actually outperformed, so did financials. But what's interesting is that when you look at the market, whether it's the S&P 500 or the NASDAQ, or really 10 out of the 11 sectors that make up the S&P 500, if you just look at how, let's say, the whole sector did, okay, energy and financials did well, most of those sectors are dominated by 2 or 3 or 4 stocks. So as a result, it's not energy doing well as much as it is 2 or 3 stocks that have a very high weighting in that index. And again, we look at this through exchange traded funds, ETFs, or through the individual stocks themselves. And so I think the takeaway for investors, because apart from the stats, I mean, that'll be, gone, and we'll be on to something else probably, by next week. But the takeaway is know what you own and understand that the indexes tend to be very top heavy unless they are constructed otherwise. And so again, it wasn't so much energy, financials, communication stocks doing well across the board. It really was the biggest continuing to do better. And the more that's starting to broaden out, starting in the second quarter, I would say the more even-handed it might be and easier for people who are trying to get ahead by finding stocks, businesses, kind of like in the old days, as opposed to trading what's moving. The other thing about that is that if you look at why technology stocks were kind of middle of the pack, which is not where they're used to being. They're used to being in the front of the race. A lot of it has to do with Apple, because Apple was down over 10% in the quarter. And it really does kind of show how top heavy the market has become. And if you look at symbol is XLK, which is the technology sector of the S&P 500, owns all the tech stocks in the S&P. Great. There's a lot of stocks in there. However, Apple and Microsoft combined make up about 46% of the tech sector. So, the other several dozen are kind of along for the ride. Together they make up about as much as Apple and Microsoft do. And again, anytime we look at performance, I try not to just look backward, because the one thing we've discussed about past performance, the only guarantee is that you can't have it because it was in the past. So I would rather look forward, and so let's do that. So looking at some of the things that are becoming deeper trends in the stock market in particular. Energy is doing pretty well, traditional energy. Alternative energy is not. Some of the ETFs, and again, I refer to ETFs because they're not just investments that I am quite familiar with after 30 years of managing money with them, but also the ETFs mostly track indexes. And so if you want to see how, let's say, clean energy stocks are doing, well, you can look at a bunch of individual stocks and it might be a little confusing, or you can look at an ETF that, and there's several of them, let's say, that track a basket of alternative energy companies. And a lot of those were down 10, 20% or more in the first quarter. There was one that I looked at, it's one of the longer tenured ones, been around for a long time, and it's down 71% since the start of 2022. So that doesn't mean they're continuing to go down. I think it's just another reminder of how many ways you can lose money and maybe take years to make up for it by taking the oversimplified "I'm a long-term investor" mantra. I'm a long-term investor too, but the long term is a sum of lots of little short-term periods. And I mean, personally, I've never been the type of investor to say, well, it's okay if I take $100, proverbial $100, and I turn it into 50 cents or 30 cents, because, the market always comes back. We're living through we're almost at a quarter century here now, which is kind of amazing. But about half of that time, half of the last 25 years, was a period in which the S&P 500 went from here to the same place. There was zero return for about 12 or 13 years. And so
how does that happen?
How does it happen?
Yeah.
Usually speculative bubbles that go too far. I mean, look, I think we're in one now, but it doesn't matter what I think. And because investing is not about predicting the future, it's evaluating reward and risk and figuring out how much reward you want to pursue once you've measured the risk. And I'll talk about that, I think, before we finish. There was one theme that I would say, kind of moving past the first quarter and, if you will, lessons learned. I decided to spare you and the audience this month and not just cite a bunch of statistics, which they can probably get anywhere, especially on Forbes. So there is a theme building, and let's see when we talk in another month or 2 months. It's not Revenge of the Nerds, a famous movie from my generation, but Revenge of the Rest. And what I mean by that is, depending on how you look at it, if you take the S&P 500, some people would argue that 7 stocks, the Magnificent Seven, as they call them, have really accounted for almost all the returns. And I want to clarify this for the audience, because I think there's a lot of truth to the idea that a small number of stocks have carried the market higher. So if you look at, let's say, S&P, NASDAQ, the Dow less so, which is kind of why I like the Dow. But if you look at S&P 500 and you look over the last couple of years, you will see that there have been a small number of extremely large winners. And we know the names: NVIDIA, Microsoft, Amazon, Alphabet, formerly known as Google, Meta, formerly known as Facebook. A lot of name changes going on, but that whole group, okay, and they're dropping like flies a little bit. Tesla's been off, and Apple, as I mentioned before. So, but they, over the last few years, I think the public impression is partially true. If you take that Magnificent Seven and maybe a few others around it, okay, they've done extremely well, and you can look at what we call contribution to the portfolio, or attribution analysis, they call it, and say, okay, if you look, and the S&P did X for the year, I'm not going to run a lot of numbers and confuse everybody, okay, and maybe myself too. If you look at the returns of, let's say, the S&P 500 the last couple of years, what you will find is that all of the return pretty much came from a relatively small number of companies. Let's just say, to pick a round number, it was 10 companies. Well, what does that mean about the other 490? it doesn't mean that they went down. It just means that out of the other 490 in this example, you had winners and losers, but they all kind of broke even in the end, you know?
Mm.
And that's why I think a lot of people's portfolios are maybe making them feel artificially high in value. I mean, it's real money, but I guess my message to the general investment audience is make sure that your success in the last year or so is not due to just a small number of winners. And if it is, make sure you're comfortable with whatever happens to those winners, because cycles have repeated through history. Late 99 into 2000 was a lot like this in many ways. There's even a great chart I saw with somebody. They said they tracked the price chart of NVIDIA, who everybody knows now, and NVIDIA, going up and up and up, looks just like a company called Cisco. CSCO, the symbol, not the food company Cisco, and Cisco back then was one of the super stocks. And what happened instead is it got to those heights, and then basically it crashed, and along with a lot of other .com bubble heroes. And it took in some cases 10 to 20 years or more for them to break even. I'm not trying to scare people. I'm just trying to remind them that risk exists, and that kind of leads me into, if you don't mind, what I would call revenge of the rest.
Okay, revenge of the rest. What do you mean by that?
So the stock market is starting to broaden out. I'm a diehard chartist. Late father taught me when I was 16 years old, and I'm a lot older than that now. So I've been at this a while, and the market always tells us a story. We just have to listen to it, and I am very much paying attention. And what I'm seeing is that this very narrow group of mega cap stock leaders are starting to, at the very least, tire out, maybe roll over. We'll see. We've had a lot of fake outs this way. But as the market starts to broaden out, that means that things like good old American industrial companies, a lot of their stock prices are starting to look a little bit better. Some things that are related to commodities, because there is a concern about inflation reaccelerating. I think that concern is real. I think we're seeing it in the prices of certain stocks that are related to commodity prices. And I think we are definitely starting to see it in the potential for interest rates, especially longer term interest rates, to reaccelerate higher. And if that happens, that could end up being the one thing the stock market didn't think would happen, hope wouldn't happen, and then it's happening. And again, I'm a historian with this stuff, so I do go back to the 1970s when, I was a high schooler or a grade schooler, but from reading the history, you had inflation come on the scene. Everybody was a little bit uncomfortable for a little bit, and then it receded and everybody relaxed, and then wham, through the roof. I still remember the gas lines. Anybody my age who's listening, you can only get gas in your car every other day, depending on whether your license plate ended with an even number or an odd number. They were rationing gas. Wow. Look it up.
Oh, wow.
So,
You mentioned the stock market broadening out. How does your YARP approach contribute to identifying more stocks for consideration compared to previous years?
Yeah, I am so glad you asked. YARP is yield at a reasonable price. It is a trademark factor, if you will, that I apply to dividend stocks. I actually invented it one summer several years ago with my then 19-year-old son who was interning with me. And so he certainly gets some of the credit for that. But YARP basically says, look at the history of a stock's dividend yield and look at a couple of other factors and look at how it's trending. And that will give you, in a lot of cases, an early clue as to whether you can lock in a pretty decent dividend yield and get price appreciation. So what's happening now, and the reason I'm now starting to talk about YARP, write about YARP, there's a Forbes article about YARP, which the editors asked me to do, which I was thrilled, because I think it's obviously the only one of its kind as far as I know, because we are pursuing a trademark. But I think it's a time where dividend investors can now look at the YARP approach and say, hey, if I find good businesses, that's great. But how do I know that I'm not buying them at very overvalued prices? And that's really what it does. And it kind of combines dividend stocks, quality stocks, and technical analysis, my charting that I've been doing for over 4 decades. When I look at that now, I don't find a whole lot in technology, although I do see what I would call sort of the underlings in technology, not the big names, but the ones that maybe yield 3% or so and haven't kept up with, like I said before, the deceptive, if you will, return of some of the biggest companies, even in the good sectors like tech. There's the biggest tech, and there's, let's call it big, but not quite as big tech. And I'm seeing some things there. I'm seeing a lot in things like the food and beverage stocks, and that's an easy one to figure out why they would be at least cheap. It's one thing to be cheap. It's another to be cheap and in a position where it won't get cheaper, okay? Because that's not good. You don't want to, buy it cheap and sell it cheaper, okay? That means you've lost money. And, if you think about the whole Ozempic thing and that class of drugs has done wonders for a couple of stocks of the drug makers. It has really, really hammered some of the companies that make, shall we say, comfort food. And I don't mean like you go to a nice restaurant and they serve you an upscale burger. I'm talking about chips and soda and things like that. Okay, those companies have been hit pretty hard, and I'm starting to see early signs that maybe that's it. I see some things in energy. I see some things. I'm not the biggest fan of gold, but I see some things brewing in the gold miners, and if they pay a dividend, then I'll look at it. And I think the main thing would be industrial companies. I mentioned at the beginning of our discussion today that there are 11 sectors of the S&P. 10 of them are weighted toward a small number of stocks. The only one that is a little bit more even-handed, where if you buy the sector, you're getting a lot of companies that are kind of weighted about the same because they're all about the same size, and that is the industrial sector. Symbol for the ETF is XLI. It's part of a group of 11 that they run over at State Street. And so whether it's chemical companies or other types of industrial manufacturers, sort of good old blue chips as we call them, a lot of those are in the Dow, a lot of them aren't. And so those are the places where things are just starting to get on my radar. And if this continues, when we speak in another month or two, I think I'll be able to report a little bit more on how, let's call it, the new wave of YARP type stocks are doing a little bit better, because for years the dividend stock set was not a great place to hunt for good long-term total return investments, but I think it's coming back around.
Well, thank you so much for joining me today, Rob.
My pleasure.